What if I told you that a small, shiny metal sitting quietly in vaults around the world is screaming a warning that most people are completely ignoring? Gold just crossed $3,000 per ounce. Let that sink in for a moment. $3,000 for 1 ounce of metal. But here's the thing. Gold is not just a pretty piece of jewelry. Gold is the world's oldest financial alarm system. And right now, that alarm is going off louder than it has in decades. So what is gold actually telling us? What does this mean for your savings, your investments, and your financial future? Because this is not just a story about gold. This is a story about the US dollar, government debt, global war fears, and a financial system that is under more pressure than at any point since 2008. Stay with me for the next 12 minutes, because by the end of this video, you will understand something that most people around you will never know. Let's get into it. Chapter 1. What is gold really? Before we talk about $3,000, let's make sure we understand what gold actually is and why it matters. Gold is not just a commodity like oil or wheat. Gold is money, real money, the oldest form of money in human history. For thousands of years, from ancient Egypt to the Roman Empire to medieval Europe, gold was the foundation of every major economy on Earth. In 1944, after World War II, the entire global financial system was rebuilt around gold. Every major currency in the world was pegged to the US dollar, and the US dollar was pegged to gold at $35 per ounce. This was called the Bretton Woods system. Then in 1971, President Nixon made one of the most consequential financial decisions in modern history. He took the United States off the gold standard completely. The dollar was no longer backed by gold. It was now backed by nothing but government promise. This is called a fiat currency system, and here is what happened next. In 1971, gold was $35 per ounce. Today, gold is $3,000 per ounce. That is an increase of over 8,500% in 50 years. That is not gold becoming more valuable. That is the dollar becoming less valuable. Gold is simply holding up a mirror and showing us exactly what our currency is really worth. Chapter 2. The $3,000 milestone. Now let's talk about this specific number, $3,000 per ounce. This is not just a random price. This is a milestone that financial experts have been watching for years. Here is how gold got here. In 2000, gold was around $270 per ounce. After the September 11 attacks and the Iraq War, gold climbed to $700. After the 2008 financial crisis, gold surged past $1,000 for the first time in history. In 2020, during COVID, gold hit $2,000 per ounce for the first time. And now, in 2025, gold has crossed $3,000. Each time gold made a major jump, there was a major crisis behind it. A war, a financial collapse, a pandemic, a debt explosion. And right now, in 2025, we have all of these things happening at the same time. We have the US-Iran conflict heating up. We have the Russia-Ukraine war still ongoing. We have United States national debt at $34.5 trillion. We have inflation that refuses to fully go away. And we have central banks around the world buying gold at the fastest pace in over 50 years. Gold is not moving higher because people suddenly love jewelry more. Gold is moving higher because the world's smartest financial institutions are quietly preparing for something very serious. Chapter 3. Why central banks are buying gold. Here is a fact that should stop you in your tracks. In 2022 and 2023, central banks around the world bought more gold than at any time since 1967, over 1,000 tons per year. These are not ordinary investors. These are the institutions that manage entire national economies. The Reserve Bank of China, the Reserve Bank of India, the Central Bank of Turkey, the Central Bank of Poland, the Central Bank of Russia. And the question you have to ask is, why? Why are the most sophisticated financial institutions on the planet, the ones with access to every investment in the world, why are they choosing to buy gold at this specific moment in history? The answer tells us everything. These central banks are reducing their dependence on the US dollar. For decades, the US dollar has been the world's reserve currency, meaning almost all global trade was settled in dollars. Oil was priced in dollars. This gave America enormous financial power, the ability to print money and have the world absorb the cost. But something has shifted shifted. After America froze Russia's foreign currency reserves following the Ukraine invasion, other nations began to panic. They realized something terrifying. If their reserves were held in dollars, America could freeze them too, at any time, for any political reason. So they started moving their reserves into gold, because gold cannot be frozen. Gold cannot be sanctioned. Gold cannot be printed. Gold belongs to whoever holds it physically. This shift from dollar reserves to gold reserves is one of the most significant financial trends of our generation, and most ordinary people have no idea it is happening. Chapter 4. What gold tells us about the dollar. Let us be very clear about something that the mainstream financial media rarely says out loud. When gold goes up, the dollar goes down. Not always immediately, not always obviously, but always eventually. Think of it this way. If you had 1 ounce of gold in 1971, you could sell it for $35. With $35 in 1971, you could buy a very decent suit, fill your car with petrol several times, and have money left over. Today, that same 1 ounce of gold buys you $3,000. But that $3,000 buys you roughly the same amount of real goods that $35 bought in 1971. The gold did not change. The gold bought you the same real value. The dollar changed. The dollar lost over 98% of its purchasing power in 50 years. This is the hidden tax that governments never announce. Every time a government prints more money, every dollar in your wallet becomes worth slightly less. Your savings quietly erode. Your purchasing power silently disappears. And right now, the United States government is running a deficit of nearly $2 trillion per year, meaning America is spending $2 trillion more than it collects in taxes every single year. And it is borrowing that difference and paying interest on that debt, interest that now exceeds $1 trillion per year. Gold sees this, and gold is reacting accordingly. Chapter 5. War and gold. Throughout all of human history, war has always pushed gold higher, always, without exception. And right now, the world is more militarily active than at any point since World War II. The Russia-Ukraine war has been ongoing for over 3 years. There is no clear end in sight. The U.S.-Iran tensions have escalated into direct military strikes. The Middle East is the most unstable it has been in decades. China-Taiwan tensions continue to simmer, with military exercises increasing every single year. North Korea continues to test ballistic missiles at an alarming pace. And here is what war does to gold specifically. War creates uncertainty, and markets hate uncertainty. When investors are uncertain, they sell risky assets. They sell stocks. They sell corporate bonds. They sell currencies of unstable nations, and they buy gold. Because in times of war, gold has one unique property that no other asset has. It cannot be bombed. It cannot be hacked. It cannot be defaulted on. A government can collapse, and your gold is still gold. This is called the safe haven effect. And in 2025, with multiple active conflicts around the world, this safe haven demand is pushing gold to record highs. Goldman Sachs has recently raised its gold price target to $4,000 per ounce by 2026. JP Morgan and Bank of America have made similar projections. These are not small regional banks. These are the biggest financial institutions on the planet, and they are all pointing in the same direction. Chapter 6. What this means for your savings. Now let us bring this home. Let us talk about what this actually means for you, for your family, for your financial future. If gold is telling us that the dollar is losing value, what does that mean for the money sitting in your bank account? Here is the brutal truth. If your savings are sitting in a regular bank account earning 2 or 3% interest per year, and inflation is running at 4 or 5% per year, you are losing money in real terms every single year. Even though the number in your account is going up, what that number can actually buy is going down. This is called negative real interest rates, and it is quietly destroying the savings of millions of ordinary people. Now, this does not mean you should run out and spend all your savings on gold tomorrow. That is not the point. The point is this: having 100% of your wealth in cash or in a bank account in an era of rising inflation, exploding government debt, and global global instability is a very high-risk strategy, even though it feels like the safe option. The world's wealthiest families, the Rothschilds, the Rockefellers, sovereign wealth funds, they have always kept a portion of their wealth in hard assets, physical assets that governments cannot print more of: gold, silver, real estate, oil, commodities. This is not conspiracy theory. This is basic wealth preservation strategy that has worked for hundreds of years. Chapter 7. Where is gold going? So the big question, where does gold go from here? Let us look at what the experts are saying. Goldman Sachs, $3,900 per ounce by end of 2025. Bank of America, $5,000 per ounce within the next 2 to 3 years. JP Morgan, gold remains in a structural bull market driven by central bank buying and de-dollarization. Now, no one can predict the future with certainty. Markets are complex and unpredictable. But what we can do is look at the underlying forces driving gold higher and ask whether those forces are likely to increase or decrease. Government debt increasing. The United States adds approximately $1 trillion of new debt every 100 days. Central bank gold buying increasing. No sign of slowdown. Geopolitical instability increasing. Multiple active conflicts with no resolution in sight. Inflation still elevated. Federal Reserve struggling to bring it fully under control. Dollar dominance slowly declining. More nations trading in non-dollar currencies every year. Every single major force driving gold higher is getting stronger, not weaker. This does not guarantee gold will reach $5,000, but it does suggest that the conditions that brought gold from $2,000 to $3,000 are not going away anytime soon. Chapter 8. What should you do? Now the most important question. What should an ordinary person actually do with this information? First, and most importantly, I am not a financial advisor. Nothing in this video is personal financial advice. Always consult a qualified financial professional before making investment decisions. But here is what financial history tells us. Many respected financial planners suggest that having between 5 and 15% of your overall investment portfolio in gold or precious metals is a reasonable hedge against inflation and currency devaluation. This does not have to mean buying physical gold bars and storing them under your bed, although that is an option. There are several ways to get exposure to gold. Physical gold, coins, or small bars purchased from reputable dealers. You own the actual metal, maximum security, but requires secure storage. Gold ETFs, exchange-traded funds that track the price of gold. Very easy to buy through any brokerage account, highly liquid, but you do not own physical gold. You own a paper claim. Gold mining stocks, shares in companies that mine gold. When gold price rises, mining company profits often rise even faster, but carries additional company-specific risk. Digital gold platforms. Some financial apps now allow you to buy fractional gold digitally, very accessible for smaller investors. The key point is this: gold is not an investment designed to make you rich quickly. Gold is insurance. It is protection against the slow, quiet destruction of your purchasing power by inflation and currency debasement. Think of it like this: you do not buy car insurance hoping to have an accident. You buy it because if the worst happens, you are protected. Gold is financial insurance, and right now, the risk of the worst happening is higher than it has been in a very long time. So let us bring everything together. Gold crossing $3,000 per ounce is not a random market event. It is a signal, a warning from the oldest and most reliable financial instrument in human history. It is telling us that government debt is out of control, that the dollar is under pressure, that geopolitical risk is rising, that central banks are quietly positioning themselves for a world with less dollar dominance, and that the financial system we have all grown up trusting is under more stress than most people realize. The question is not whether you believe in gold as an investment. The question is whether you believe in protecting what you have already built, because history, thousands of years of it, shows us one consistent truth. Governments rise and fall. Currencies are printed and destroyed. Empires come and go. But gold always holds its value. The warning has been sent. Whether you choose to listen is entirely up to you.